Something absolutely unprecedented just happened in the silver market. And if you're holding physical silver or thinking about buying, you need to understand what went down last Friday, because it reveals the entire game being played right now. Physical silver demand just exploded to levels never seen before, while the paper price crashed 40%. One major bullion dealer processed 2.5 times more transactions than their previous all-time record. That prior record happened during the Silicon Valley Bank collapse in 2023. Friday's revenue for this single dealer exceeded what they generated in some entire months during 2025. But here's where it gets insane. On the same day, 1.8 billion ounces of silver were traded on COMEX. Annual global mine production is approximately 800 million ounces. They traded more than double total global annual production in just a few hours. More than 2 years' worth of mining output changed hands in a single trading session. Meanwhile, the physical market remains incredibly tight. Multiple dealers are rationing silver. Sovereign mints are struggling to keep up. New mint orders are running 8 to 10 weeks out right now. 30 days ago, delivery times were 2 to 3 weeks. That's a massive shift in a very short period. Let me explain exactly what happened on COMEX last Friday, because the numbers tell an incredible story. 1.8 billion ounces of silver were traded. Annual global mine production is 800 million ounces total. They traded more than 2 full years of global production in a few hours. But here's the smoking gun. After all that massive trading volume, most of those contracts were closed by end of day. Positions were opened, the price was smashed down dramatically, then the positions were closed and exited. They weren't buying silver, they weren't taking delivery, they were dumping paper contracts to crash the price, then immediately exiting. This is textbook manipulation. Normal months see trading volume around 100% of open interest, maybe 120% on volatile days. Friday hit 345%, more than triple normal activity, and it was concentrated almost entirely in the March contract, which happens to be a primary delivery month. They dumped unprecedented paper volume, specifically to avoid having to deliver physical silver in March. A volume of 317,000 contracts, equivalent to approximately 1.586 billion ounces, represents roughly 2 years of global mine production. Dumping this volume in a single day during a 40% price crash doesn't suggest organic market activity. This appears to be deliberate price smashing, designed to trigger stop losses, force liquidations, and destroy bullish sentiment. Now let's connect this to broader context. Friday saw metals crash across the board. Silver down 31%, the biggest daily loss on record. Major banks closed hundreds of short contracts at the exact bottom, timed it perfectly, and exited. Markets sold off partly on news of potential Federal Reserve policy shifts. Talk of a new Fed chair who's anti-quantitative easing. Markets reacted to that policy shift away from unlimited liquidity. But here's the deeper truth. Friday's crash wasn't just about Fed policy or dollar strength. Those were fundamental drivers, yes, but also convenient catalysts. The policy announcement provided perfect cover to execute the largest paper dump in history. 1.8 billion ounces, 2 years of global production. They used legitimate news as camouflage for blatant manipulation. And what happened to physical demand while paper crashed? It absolutely exploded. That major bullion dealer hit 2.5 times their all-time record in a single day. When paper silver collapses, physical buyers rush in aggressively. The spot price you see quoted is primarily a paper price. It does not always reflect what's happening in the actual physical supply chain. Just like banks don't hold all cash for every deposit, paper markets trade multiples more silver than exists in deliverable physical form. That's why you see paper silver falling sharply, while physical demand spikes dramatically. Physical product becomes scarce, and premiums widen despite lower spot prices. The paper and physical markets are diverging significantly. A major industry insider recently returned from meetings with sovereign mints from around the world. The message is absolutely clear. Production capacity is being completely overwhelmed. The Perth Mint temporarily shut down new sales on key bullion lines simply to catch up on existing obligations. This isn't unique to Perth. Most sovereign mints face identical problems. Limited blank supply, higher lease rates, holiday production slowdowns, and surging global demand across the United States, Europe, and Asia. As of early February, new sovereign mint orders are running roughly 8 to 10 weeks out. 30 days ago, delivery lead times were 2 to 3 weeks. This gap is expected to worsen as supply pipelines absorb Friday's shockwave. If it isn't already in the pipeline, it likely won't arrive quickly. The market reacted with fear, selling off on the assumption that new Fed leadership will raise rates to whatever level necessary to crush inflation. This is complete fantasy. It's a narrative that completely ignores the mathematical reality of the U.S. fiscal situation. When Paul Volcker raised rates to 20% in the early 1980s, the U.S. debt to GDP ratio was 30%. The country could afford it. Today, the debt to GDP ratio is 125%. And rising exponentially. The U.S. is adding $1 trillion in new debt every 90 days. Annual interest payments on the national debt have already surpassed $1 trillion and are on track to become the single largest budget item. The math will be making decisions regardless of who's Fed chair. They can't be Volcker even if they wanted to. The debt load makes it mathematically impossible. And here's another massive development nobody's connecting. The U.S. is launching a $12 billion strategic minerals stockpile to counter China. Lithium, nickel, rare earths. Silver isn't mentioned explicitly, but it's right in the middle of this story. Notice how they're still afraid to mention it directly. EVs, solar panels, electronics, defense systems. There is no energy transition without silver. It's absolutely critical to everything being planned. When governments start hoarding physical materials, it's not because prices are stable and supply is abundant. It's because supply risk is very real. Paper prices can be managed and manipulated. Physical availability cannot. Strategic stockpiles mean one thing: just-in-time supply chains are dead. Physical custody is king. There's also a major U.S.-India trade deal announced. India commits to massive purchases worth $500 billion in U.S. energy and technology. This is massive for commodities because India absorbed 25% of global silver production in 2025 with inelastic demand. Now they're committing to $500 billion in U.S. purchases. Where does silver fit into U.S. tech and energy exports? It's embedded in absolutely everything: solar panels, electronics, electric vehicles. India's demand isn't going away, it's accelerating. And U.S. manufacturing data just came in at a 40-month high, significantly beating expectations. This is strong economic data showing manufacturing expanding and industrial demand for silver rising. Yet silver crashed 40% on Friday. Funny how after strong manufacturing data, silver prices went in completely opposite direction than fundamentals would suggest. This confirms manipulation, not fundamentals driving prices. Current prices show something fascinating. Western spot at $80, Shanghai spot at $101, Western futures at $80, Shanghai futures at $95. That's a $20 premium on spot and $15 on futures, 26% premium. After a 40% crash, the premium is still over 25%. The physical market is not following paper pricing. That divergence tells you everything. Now let's talk about what could still go wrong, because the bearish case is real. Major banks are calling this one of the most extreme moves in decades, with volatility approaching levels not seen in almost 50 years. This is brutal price action. If you were trading on leverage, you got absolutely destroyed. Margin calls wiped out highly leveraged positions instantly. Natural gas prices just crashed 25%. Copper tumbled more than 5% amid broad metals sell-off. The entire commodity complex is under serious pressure. COMEX raised margins. Gold margins from 6% to 8%. Silver margins from 11 to 15%. Shanghai also raised margin requirements from 20 to 26%. More margin hikes create more forced selling potential. When margins rise, traders must post more capital or liquidate positions. This creates cascading selling pressure. U.S. stock market concentration is at record levels. The market has never been this top-heavy. When this breaks, the deleveraging will be catastrophic. That's the bearish scenario. More selling, more liquidations, more margin hikes, economic stress, everything crashes together. But here's why the bullish case for physical silver is overwhelming despite short-term pain. Physical demand exploded 250% on the day paper crashed 40%. That major bullion dealer hit 2.5 times their all-time record in one day. This is verifiable retail demand data. Sovereign mints are overwhelmed. Perth Mint shut down new sales. 8 to 10 week delivery times, up from 2 to 3 weeks just 30 days ago. Limited blank supply, higher lease rates, surging global demand. This is the physical bottleneck that's been predicted for years, happening right now in real time. Every major gold bull market has had brutal mid-cycle corrections that felt like the end. The 1974 correction was negative 47%. Nearly half the value wiped out. Everyone declared gold dead, and then it ran 734% over the next 6 years. The current pullback in gold is actually modest by historical standards. In the context of the 1970s, this wouldn't even rank among the top 5 corrections. And critically, none of the structural drivers have changed at all. Central banks are still accumulating physical. Debt is still expanding exponentially. Silver remains in backwardation, which signals physical shortage. The fundamentals driving the bull market remain completely intact. You can't cure a huge physical shortage by manipulating the paper price. The manipulation has nothing to do with actual physical supply and demand dynamics. With volume at 345% of closing open interest, the March contract saw extreme turnover. After the session, 1.127 billion ounces worth of contracts were closed, leaving only 459 million ounces in open interest. This implies many traders or institutions exited specifically to avoid physical delivery obligations in March, which is a primary delivery month. The sharp open interest reduction suggests contracts were closed to evade delivery, potentially avoiding a squeeze where shorts must actually source physical silver. However, if standing deliveries remain high, it could strain vaults because COMEX registered silver stocks are down to just 104 million ounces. 104 million ounces registered. 1.58 billion ounces dumped Friday. Do the math. If even a small fraction of those contracts demanded actual physical delivery, the system breaks. There isn't enough registered silver to cover delivery. Physical silver demand was already in a 5-year deficit before this. Industrial users and investors are suddenly being offered an unexpected 40% off sale. Demand will surge in response. The manipulation bought time, but it's digging eventual graves even deeper. The more they suppress paper price while physical demand explodes, the worse the eventual snapback becomes. So where does this leave us? 1.8 billion ounces of paper silver dumped Friday. That's 2 years of global mine production traded in hours. 345% turnover in March contract. 1.127 billion ounces closed to avoid delivery. COMEX registered stocks 104 million ounces. The paper market dumped unprecedented volume while physical demand exploded. Major dealers hitting 2.5 times all-time records. Sovereign mints running 8 to 10 weeks out. This is the paper physical divergence at its extreme. The narrative that new Fed leadership will be like Volcker is complete fantasy. Debt to GDP is 125% versus Volcker's 30%. U.S. adding $1 trillion in new debt every 90 days. Interest payments already $1 trillion annually. The math makes Volcker-style policies impossible. Meanwhile, 12 billion strategic minerals stockpile launched. Silver not mentioned explicitly, but it's core to the entire story. EVs, solar, defense systems. No energy transition without silver. Governments hoarding physical means supply risk is extremely real. Historical context matters enormously. 1974, gold corrected negative 47%, then ran 734% over 6 years. Current pullback is modest by comparison. None of the structural drivers changed. Central banks buying, debt expanding, silver in backwardation, physical in 5-year deficit. Friday's 40% crash triggered 250% explosion in physical demand. When this paper manipulation finally breaks, the rebound will be absolutely historic. The unresolved tension is this: 1.8 billion ounces dumped, physical demand exploded, delivery times tripled, mints shutting down sales. But margins hiked again, volatility at 50-year highs, economic stress building. Does the paper manipulation continue squeezing over-leveraged longs, or does the physical shortage finally overwhelm the system? March is a primary delivery month. COMEX has 104 million ounces registered. If standing deliveries strain vaults, the squeeze could ignite within weeks. Understand the risks clearly. This volatility is a meat grinder for leveraged traders. Margin calls are destroying over-leveraged positions. But if you understand what's happening, 2 years of production dumped in hours, while physical demand hits 2.5 times all-time records, then you know this isn't about fundamentals. It's about desperation. They bought time by dumping unprecedented paper volume, but they're digging deeper graves. Physical will win eventually. The only question is timing. The disconnect between paper and physical cannot persist indefinitely. Invest with logic, not emotion or hype. Do your own research. Understand what you're buying and why. Don't follow anyone blindly. Make your own informed decisions based on facts and data. The silver market just showed you exactly how the game is played. Paper manipulation to control price. Physical shortage creating massive premiums and delivery delays. The question is whether you understand what that means for your positioning going forward.